All right, so Wall Street obviously contend Jay Powell and company finally on board with rate cuts, but maybe not being so honest about what's motivating the FOMC right now. In his morning note, John Hilsenrath says that Powell's key words did not make the headlines, and he's right. We do not seek or welcome further cooling in the labor market. That's a serious message there from Jay Powell on Friday. And here's probably what he was thinking about, folks. Take a look at this chart. This is your full-time employment. This is your change. We're really in a massive free fall when it comes to full-time employment here. Also, maybe, just maybe, FOMC members are also seeing some other signals here. This is some of the data I cover on this show a lot. Regional Fed numbers, PMI numbers on employment, whether it's the Philadelphia Fed, the S&P Global PMI, Empire State. You know, for the most part, this is really up a little, but look how much these are down. Just absolutely tremendous. And that's on the manufacturing side. Look at the service side. It's even worse, and this is supposed to be the strong part of our economy. Let me bring in now Wellington-Altus Private Wealth Chief Market Strategist Jim Thorne. Jim, now you're on record as saying that the Fed should have been aggressively cutting a long time ago. What do you think that at least now Powell sees the light?
Yeah, I think the other thing that he said in the Jackson Hole speech was that the labor market was looser than 2019, where he cut Fed funds rates below 2%. So, Charles, I think investors got to get ready for them getting to R star, which is the neutral rate, somewhere between 2.5% and 3% fast. I think they understand they've stayed their welcome way too long. The private sector is buckling. We have significant recessionary variables flashing red. And the only thing that's holding up the headline number is basically wartime like fiscal spending. And if we get some fiscal responsibility, which is our base case for 2025, then we might get an air pocket. And Charles, with the lags of rate cuts of at least 18 months, a cut in September will not be felt until the first quarter of 2026. The credit markets are saying they can take 150 basis points. They should take it, and they should get aggressive.
Now, this morning, we also learned that the core cap goods shipments were down 0.4, and that's been coming down here rapidly. So a lot of folks are worried about the headline durable goods. That doesn't matter. This is what's factored into GDP. So it's not even just the labor part of this economy, right? There are a lot of red flags out there, Jim.
Yes, and what we have to do is parse out the craziness in Washington, D.C. with all that excessive fiscal spending. And if you look at the private sector is in a recession. So let's just call it like it is and recognize the fact that the Fed has, I think, my opinion is that the Fed and other central bankers have delayed rate cuts, because of the unsustainable fiscal spending. I think they're getting a handle on the fact that it's going to stop, and now they've got to start cutting aggressively. This is not a normal economy, and I think it's going to surprise a lot of people on how rapid rate cuts happen.
You had a post that I want to ask you about. I got less than 2 minutes, but I got to go through this because it feels like it was aimed at economic purists. Right? You talk about financial crises, that all what they have in common is how interconnected the global economy is, particularly since 1987, where central banks have been forced to take action. Right now, the bank balance sheets are worse than they were post-Great Financial Crisis. So you mentioned a couple of things here. You mentioned a potential Minsky moment. What is that?
That's where we have a financial crisis. Charles, when I first met you, it was 1997, 1998. Financial crisis always forced the Fed's hands. And with extreme levels of debt, the extreme tightness of the Fed has caused damage around the world. That the yen carry trade was a direct, and the crash because of it was a direct response of the Fed staying too tight for too long. If they don't start cutting, the risk is not a recession. The big risk is a financial crisis. And I think Powell will not use Section 13.3 of the Federal Reserve Act ever again. And people are going to be surprised that when the Fed cuts, that the private sector is going to take a very, very long time to respond. And that's the big risk.
All right, I got 30 seconds. It might be a lot to ask, but I also got you said adopting an Austrian school approach might seem appealing, but without a debt jubilee, this is a reality that we face. It sounds like you're talking to maybe some of your friends out there that, listen, maybe there's a way to do this from a pure economic orthodox manner. What's the debt jubilee, though?
It's a reference to the Bible. It's when you wipe out everybody's debt.
Right.
Think about what President Biden's been doing over the past 4 years. He's been wiping out debt. Do you really think that that's a sustainable economic policy? And the Austrian folks just want to blow the system up. Well, we're not going to blow the system up. So they got to cut rates. Rates are going to be lower for longer. And let's hope that the innovative bubble or the innovative wave that we're in with AI and Bitcoin can drive economic growth so that we skip along and we don't go into a deep recession in the United States.
Well, by the way, the debt jubilee might just be started because in November you might get medical debt taken care of, housing debt taken care of. We might wipe it all out, Jim. You can just go to the beach, my man. Thanks a lot. It's great talking to you, as always.